everyone. Welcome to the final video in the Goodbye Canada series. In our previous videos, we've discussed how you can save literally thousands of dollars by traveling the world. We're going to introduce you to David LePoidevin. Jill and I call him the Money Man. He's great. Bottom line, he's going to show you how to keep your dollars working for you. The last thing you want is the inflation eating away at your hard-earned money. David's going to straighten all of that out. We've been with David for pretty near 20 years now, and I have to say he has been nothing short of stellar. Up markets, down markets, David has consistently produced, and we would not be where we are today without him. Just for full disclosure though, we receive absolutely zero compensation or favors from David. The only reason is we want to share with you what has worked so well for us. So let's get to it. This guy is great. Hello everyone. As promised, David LePoidevin. I've been with David now for 20 years, and Jill came over 5 or 6 years ago, and he's been instrumental in helping us get to where we are today. And you know, a big part of our travel now is the sale of our home, and you concur with us. You know, your feelings on real estate now, David?
Well, I mean, not everybody's in the same boat you are, but certainly you have been a great saver for a firefighter. I call you the wealthy barber, the wealthy firefighter. You've been smart with your money. Part of that is the investment process that we've handled, and part of it is you taking a house that was weighing you down and being able to use that capital to live the dream. And I've watched your videos, and it looks pretty good.
Yeah.
You guys look like you're doing well.
Yeah,
I'm so happy for you.
We've been having a good time, and that's for sure. I think a big part with us is just looking at the state of real estate in Canada right now. And you know, of course, if anyone knew for sure where it was going, they wouldn't be here right now. They'd be flying around in their private jet. But you know, how much higher can this market go?
Look, if you read international reports, Canada is arguably the greatest real estate bubble in the world, or top 2 or 3 in the world. And we have Houston, we have a problem. And the problem is very similar to the 09 crisis in the United States. And we had written a piece to our clients in 2007 talking about the mortgages that we're going to renew in 2008. And we said all these people that have these teaser rate mortgages, we're going to renew at substantially higher mortgage payments.
Yeah.
Well, for the second half of 2024 and into 2025, we have that same thing happening in Canada than the United States. And we have, especially in 2025, which was 5 years after the COVID year. So, I mean, I took out a mortgage. My mortgage is at 1.44%.
Yeah.
I have the ability to pay that off, but many people don't. And 1.44 renewing at 4.8 or 5.2, these numbers are akin to the same kind of thing that happened in Canada in 1991, when mortgage rates went from 7 to 13, or in 1981, where they went from 10 to 20. Moving from 1.75 to 5 is simply going to put 2 to 3 to 4% of the population into a position they cannot do it.
Yeah, I think it's going to be ugly. I really do.
Well, this is my view, and you know, we're at a point where there's so much wealth that is tied up in people's real estate. Now again, this may not be for the person in Swift Current or the person in the Maritimes, but if you live in Greater Toronto or Greater Vancouver or Victoria or many of the bubble cities, you might have the opportunity to cash out your house for $1.5 million or $2.5 or $4, some crazy numbers. And is this, you know, is it worth it? I mean, one of the things I liked about your video, Randy, was that you actually broke down how much it's costing you to sit on that much capital.
It's amazing. So a lot of our viewers, have contacted us, and they don't believe it. They don't believe the numbers when it's all there in black and white, and the numbers don't lie. But it's just so many people are just shocked.
Yeah. Well, look, for some people, their home is their pride, their backyards and their garden. So this isn't the conversation for everyone. That might be the thing that they love.
Yeah. Exactly.
But if you're Randy and Jill, I mean, hats off to you guys. This was a fantastic move.
Yeah.
And who knows what's going to happen in the global markets? But for you guys, for right now, it was a big burden financially, and it's allowing you to travel the world and not dig into your principal.
Yeah. Well, as we mentioned, we're actually saving more now than ever.
It's amazing.
But, I think what we should maybe do, David, if you could just a little something on how you might be able to help some of our viewers. It's a big step. It's a process, as we've alluded to earlier, and a big piece of the puzzle is their financial well-being.
Look, all of our clients, we only take like-minded individuals. I think if you're going to make this step, or if you're going to go into retirement, let's remember the most important thing. Don't lose your money. Okay? We cannot be speculating on the newest AI stock. Okay? Maybe that'll be a home run, but maybe it won't. We've seen these kind of things before. We saw it in 2000 with the internet stocks. The internet worked out to be bigger than we possibly imagined, yet more people lost money on the internet as an investment theme. So we're not looking to buy home runs. We have to look about safety of principle. In a perfect world, we would be buying businesses or bonds where we can't lose, or we buy really boring businesses. If you look at a company like Fortis that we pay our gas bills and our electric bills in British Columbia. This is a North American company, but it pays a 4.5% dividend, and it's a stated policy of this company to increase that dividend by 6% every year. So if you think about what's going to work for you in retirement, I'm living on 4.5%, and every year my company's going to raise the dividend. Now again, we're not going to put all of your retirement savings into Fortis stock.
Yeah.
And that's because if you bought Hawaiian Electric, you would have been cursing your advisor. And there's always risks, but those are the kind of businesses that if you have a well-diversified portfolio, that's what's going to get you through. And to me, it's a very exciting time because these higher rates have pushed down the valuations of a preferred share or a utility stock. And the fact is, the whole world is investing in the NASDAQ and the Magnificent Seven, and whether you're living in Canada or United States or Mexico or Malaysia, everybody's playing the same 7 stocks. And that is great because the average stock in the United States is at 0. The Toronto Stock Exchange is only up 5% for the year. There's so many bargains in the world. You could buy the biggest 6 companies in the United States have a higher value than the biggest 600 companies in Europe.
Yeah.
It's incredible, with a very, very similar population base and economic total growth. I mean, the valuation divergences around the world are very exciting as investors. And, to me, it's we're not married to stocks. We're not married to bonds. We don't have a predetermined outcome. And if there's nothing in the world that we like, sit back and earn a little bit of interest in cash.
Yeah.
But let's not lose.
Yeah, well, that's been our number one thing, with us is I've been rough on Dave because I hate losing money, and
we had some conversations around COVID,
and nothing's ever straight up or straight down, but we're very conservative investors, as you know, and I think the best thing you can do is come in, have a talk with David, because you all have different risk levels and different objectives. And but he's been great for us. And
Hey, Randy, you're not very conservative. Very conservative is you've been rolling GICs at 1 or 2%.
Oh, okay, yeah.
You actually, no, you get it. You get it. I mean, I think you've been a good client, and I think we get along, and I'm looking for clients that they want a reasonable return. And to go up risk, you can get a lot more return by just taking a small amount of risk, and you do not need to push the risk envelope over a long-term basis.
Yeah.
Because I think we shine when the markets get rough. And let's remember, the valuation of U.S. stocks is at the high end of its range. But that doesn't mean there's not a lot of bargains to buy within the United States, within Canada, with Europe looks very appealing. So I think it's still an exciting time.
Yeah, and that's what we cannot handle, is the huge losses, and that's what attracted us to David. Was through 2008, his record speaks for itself, and rather than me repeating, maybe some of your numbers, when it's something I remember.
Well, we, 2008, we lost 2% on average for our clients. And we had somebody come in, and his buddy had convinced him that we were lying and we must be like Bernie Madoff, because there's no way I could only be down 2%. But our stock exposure was down to about 20 or 25%. We had a heavy investment in government bonds. The bonds went up. Yes, we lost a little bit, but that was literally the thing that kicked off myself to be, a top-ranked advisor, which was, how we did. And literally, I think I got 1 or 2 referrals from every single client after 2009, and them coming out okay.
Yeah, well, so, a lot of people, still to this day, I hear it said, in 2008, if you didn't lose 20, 30, 40%, you didn't have anything to lose to start with, and that's not the case.
Well, and you and I have talked, Randy, and one of the dangers that people don't see is that could be coming to Canada. Okay, so from an investment perspective, it's coming. The mortgages, maybe rates will be back down to 1.5%. I don't think so. I think there are some Bank of Canada type loosenings, but we are not going to see the bottom of this range back in the zeros and mortgages at 1 3/4. Yeah. I don't think you'll see that again in our lifetime. Yeah. And so I think we have a problem. The mortgages are going to come due. We're already seeing cracks, especially in the Greater Toronto, where there's a lot of speculation. Yeah. And you're starting to see it in Vancouver too, in the condo market, where the prices haven't come down, but just like the United States, it gets weak before the numbers come down. So I think from an investment theme perspective, let's be careful of Canadian credit. It'll have implications of the currency. As an international traveler, you tell me, Randy, if you went with Canadian dollars into somewhere in one of your travels, what would they say to you?
Well, they'd probably first say, "What's that?"
Yeah. What do they say if you have U.S. dollars?
Well, exactly.
Everybody knows exactly what the exchange rate is. Yeah. When I went to Argentina, it's illegal to own U.S. dollars in Argentina when I went.
Oh, really?
But of course they all wanted them.
Well, yeah.
So if you were going for a steak dinner in Argentina and you told the maitre d' that you had U.S. bucks and you're willing to pay with cash, the price of your dinner would go, oh, you'll cash?
Same when we were in Egypt. And I remember one of our dive masters, and I tipped him in U.S. dollars, and his eyes, and now you look, since we've been in Egypt, which wasn't very long ago, the currency's down another 50-60%. We're going back. It's cheap. It's cheap right now, Egypt, and the Red Sea's spectacular.
Got it. Yeah. Well, I, I really will look forward to enjoying watching your travels.
Yeah.
And I'll leave the stress to me.
Yeah. Okay. Yeah, I'll do that very happily. Anyway,
Right
David,
on.
hey, good seeing you again. And when are we going to be back? I don't know. Year, two?
See you when we see you.
Yeah. Okay. And
Okay.
thanks, David.
You're welcome.
Hope you really enjoyed the video today. If you'd like to contact David personally, we've listed all his contact info in the description below. And as always, please remember to subscribe, like, and share. You can also follow us on Facebook, Instagram, and LinkedIn. We're currently in the UK, and we've got some great videos coming your way. See you all soon.
I don't know who I'd be would everything we built just turn to broken leaves. I don't think about